This presentation will attempt to explain what mortgage insurance is, why lenders require it, what it costs, how it's paid, and how a borrower can save thousands of dollars on transactions requiring mortgage insurance by utilizing AmeriFund's PrimePremium PMI program to avoid monthly PMI payments. So what is mortgage insurance and why do lenders require it? Let's use an example to illustrate. For this example, let's assume that Mr. Smith purchases a home for $300,000 and he is putting 5% down. His equity in the property is $15,000 and the amount of the mortgage loan is $285,000. Now, what if Mr. Smith fails to make the payments on his mortgage and the lender has to foreclose? Let's assume Mr. Smith never made a payment and his loan balance is still $285,000. When the home sells at foreclosure, it typically sells for much less than the price at which the borrower purchased it. That $300,000 home that Mr. Smith purchased would likely sell at foreclosure for $250,000 or less. Well, if the mortgage company lent him $285,000 and the lender only collects $250,000 from the proceeds of the foreclosure sale, the mortgage lender will experience a loss of $35,000. They have recovered less than they paid. To ensure against this unfortunate financial outcome, the lender requires the borrower to maintain mortgage insurance from a private insurance company that will compensate the lender for any shortfall at the foreclosure sale. This insurance is called private mortgage insurance, or PMI. It is required when a borrower's equity or down payment on a purchase is less than 20%. The more money a borrower puts down, and therefore the more equity in the property he has, the less risk there is that there will be a loss in the event of a foreclosure. For that reason, the cost of private mortgage insurance increases as the borrower puts less money down. Requiring a borrower to maintain private mortgage insurance until the equity in the borrower's home reaches at least 20% isn't just something that lenders do as a precaution. It is actually required by the federal agencies that set the guidelines for qualification and eligibility for mortgage loans in the United States. On a 30-year fixed rate mortgage or any adjustable rate mortgage amortized over 30 years with 5% down, the borrower is required to maintain PMI for 109 months. That's slightly more than 9 years. With 10% down, the PMI must be maintained for a period of 85 months, just more than 7 years. The date on which PMI is canceled is determined based on the amortization of the loan as it existed at inception. It will only be canceled when the principal balance, indicated by the amortization schedule provided at the time of closing, is less than 80% of the value or purchase price, whichever was lower, at the time the loan was originated. Subsequent payment of principal more rapidly than the original loan terms will not reduce the amount of time a borrower is required to maintain PMI prior to cancellation by law. Nor will the increase in value of the property over time enable a borrower to cancel PMI sooner. The value on which the cancellation is based is the value or the purchase price, whichever was lower, at the time the loan was originated. A subsequent increase in value does not entitle the borrower to cancellation at an earlier date. The amount a borrower pays for PMI is called a premium. The premiums for PMI can be paid monthly as part of the borrower's monthly housing payment, or the cost of PMI can be paid as a single premium paid as part of the borrower's closing costs. The PMI premium that is added to the borrower's monthly payment depends on the borrower's median credit score and on the borrower's equity position in the property securing the mortgage loan. Borrowers putting 5% down with a median credit score of 760 or better will pay a monthly add-on for PMI as shown in this table. The amounts could vary slightly depending on the insurance company, but typically the rates for monthly PMI premiums from private insurance companies for this credit score level and loan-to-value ratio do not vary significantly from one company to another. On that $425,000 purchase with 5% down and a monthly PMI payment of $174.96, the borrower will pay a whopping $19,070.46 in cumulative PMI payments before the requirement to maintain PMI is eliminated by law. That's a lot of money. There's a better way to pay for PMI. With AmeriFund's PrimePremium PMI, a borrower can pay a single premium at closing and eliminate the monthly PMI add-on. That single premium paid at closing for borrowers with credit scores of 720 or higher is about 1/3 of the cost of paying it monthly. The potential savings from utilizing AmeriFund's PrimePremium PMI program are quite phenomenal. With 5% down and a purchase price of $425,000, for example, the potential savings is more than $12,000. To examine the table in more detail, pause the video and resume it when you're ready to view the remainder of the video. The single premium for the PrimePremium PMI can be paid by the borrower at closing, which increases the cash required at closing, can be paid by the seller in a purchase transaction, or can be paid with a credit paid by the lender to the borrower at closing in exchange for accepting a slightly higher interest rate. To have the seller pay the premium, the borrower must negotiate in the contract with the seller to have that premium paid. By offering a higher purchase price to obtain the seller concession, the borrower can obtain the savings of the PrimePremium PMI program without having to bring additional funds to closing. Alternatively, the borrower can accept a slightly higher interest rate of 1/4 to 3/8 of a percentage point on the new mortgage loan and receive a credit from the lender paid at closing sufficient to pay the single premium for the PrimePremium PMI. Although the higher interest rate will result in a nominally higher principal and interest payment, that increase would only be a fraction of the amount of the monthly PMI payment that is being avoided. Thus, it is a much better option than a transaction with monthly PMI for most borrowers. As an alternative to a transaction with PMI, AmeriFund and many of its competitors offer what's called a piggyback loan. With a piggyback, the borrower obtains two loans, the first lien at an 80% loan-to-value ratio and a second loan for the remainder of the amount being financed. For example, with 5% down, the second lien would represent 15% of the purchase price. Because the first lien is at an 80% loan-to-value ratio, mortgage insurance is not required with this type of loan structure. However, with a dual loan piggyback, the lender fees on the first lien mortgage are increased due to a loan level pricing adjustment imposed by Fannie Mae and Freddie Mac on transactions with secondary financing. And the interest rate on the second lien mortgage, representing more than 15% of the total overall financing, is almost twice the rate of a 30-year fixed rate on a first lien. For this reason, AmeriFund's Prime Premium PMI will have a lower total payment and lower cost than a piggyback loan where the borrower has a median credit score of 720 or higher. However, the piggyback structure for financing might be a valid option for credit scores in a range from 680 to 719. This example compares the payment and cash required at closing on a transaction with monthly PMI, one with AmeriFund's Prime Premium PMI, and a piggyback loan structure with an 80% first lien and a 15% second lien. This example assumes a purchase price of $375,000 with 5% down and a median credit score of 740 or higher. As you can see, the monthly PMI premium in this transaction increases the total payment to $2,870.58 with estimated cash required at closing of about $22,544. The interest rate on the first lien mortgage with the piggyback dual loan structure has to be increased by 1/4 percentage point due to the pricing adjustment for secondary financing. By increasing the rate to 4.5%, we can keep the closing costs to something just above $22,800, similar to the bottom line on the transaction with monthly PMI at 4.25%. But the combined payment on this interest rate is still lower than the payment with monthly PMI. In this example, we increased the interest rate on the Prime Premium PMI option to 4 5/8 to provide the borrower with a credit that is sufficient to pay the single premium for the PMI at closing and with some additional credit going to reduce closing costs. The monthly PMI is eliminated and the principal and interest payment increases slightly to $1,831.62. But the overall payment at just over $2,769 is much lower than the combined payment on either the monthly PMI or piggyback alternatives. And the closing costs are about $2,000 less than with the other two options. The lower payment with the Prime Premium PMI, combined with the lower cash required at closing, will save the borrower several thousands of dollars over the first 9 years. Although none of our competitors offer the Prime Premium PMI alternative, a few do offer something similar called Lender-Paid Single Premium PMI. This program for PMI also utilizes a single premium that the lender, not the borrower, pays at closing. The lender increases the rate or the closing cost charged to the borrower to obtain enough additional compensation to pay for the single premium at closing. However, the amount charged to the borrower for the premium with AmeriFund's Prime Premium PMI is typically $1,000 to $2,000 less than the amount charged to the borrower on a lender-paid single premium program. Take the challenge. Call an AmeriFund loan consultant today for a free analysis showing how much you can save with AmeriFund's Prime Premium PMI.